There's a procedure in aviation called a weight and balance check. Before a single wheel leaves the runway, before the throttles go forward, before anything moves, you calculate every number: fuel load, payload distribution, center of gravity. You are not guessing, you are not hoping. You are reading exactly what the instruments are telling you, and only then do you make a decision. Smart investors should do the same thing with earnings, because every quarter is a check of the instruments, not opinions, not headlines, not narratives, just numbers. And this morning, one of the most important railroads in a long-term industrial portfolio checked in with its first quarter 2026 results. This is Captain Pierce. Welcome back to SkiesCapital. Think clearly, invest better. Union Pacific reported Q1 this morning, and I'll tell you straight, after every pre-flight check we've run on this company, after every layer of analysis we've built in this series, today's reading is clean. The gauges are mostly in the green. Over the next 25 minutes, we're going through the full report: the revenue, the margins, the segments, the productivity metrics, the cash flow, the balance sheet, the guidance, and the one variable that still has the needle flickering a little: the merger. We're going to do what SkiesCapital does best: separate signal from noise, separate facts from narrative, and land on a clear, honest verdict. This is the captain's log. Let's go. Let's start with the headline numbers. Then we'll go under the cowling on what's driving them. Union Pacific delivered $6.22 billion in revenue, up 3% year over year, and a record first quarter. Adjusted EPS came in at $2.93, ahead of consensus and above last year's level. Reported EPS was $2.87, reflecting $36 million of merger-related costs, or about 6 cents per share. Adjusted operating ratio was 59.9%, better than expected, and 80 basis points better than Q1 a year ago. Freight revenue was $5.89 billion, up 4% year over year. Another record first quarter. Return on invested capital remains industry leading, with ROIC around 16.3%. Net income came in at $1.70 billion, up 5%, also a record Q1. Operating income reached $2.46 billion, up 4% year over year. Another record first quarter. Operating cash flow came in at $2.44 billion, up 10% from $2.21 billion a year ago. And free cash flow improved to $631 million, up 35% versus last year. Now think about this for a second. In one quarter, and in the seasonally softer first quarter no less, Union Pacific set records for operating revenue, operating income, net income, freight revenue, and freight revenue excluding fuel surcharge. That is not noise. That is the machine running at altitude. Now let's look at the beat or miss scorecard. EPS beat, revenue beat, operating ratio beat, freight revenue growth beat. That is 4 for 4. And the operating ratio trend matters here. If you follow the line from Q1 2024 to today, the direction is clear. Union Pacific has continued to push adjusted OR lower, from roughly 61% to 59.9%. Q1 is usually a softer quarter. That part is normal. What is not normal is delivering a sub-60 adjusted operating ratio in Q1 while also posting record first quarter revenue, income, and freight revenue. That tells you this team is not coasting. They are executing quarter after quarter, and they are doing it at a level most railroads would love to call their ceiling. Let's go under the cowling on where this revenue actually came from, because not all $6.22 billion is created equal. Union Pacific has three main freight buckets: bulk, industrial, and premium. And this quarter, each one told a different story. Bulk was the clear standout. Bulk revenue came in at $2.026 billion, up 10% versus Q1 last year. Coal and renewables generated $486 million, up 17%, with carloads up 16%. Grain and grain products delivered $1.057 billion, up 11%, with carloads up 14%. Fertilizer came in at $236 million, up 12%. This is where the biggest lift came from. Coal, in particular, is worth pausing on. There is a long-term narrative that coal is fading out of the rail business, and over time, that may be true. But in the near term, coal still throws off real revenue and real cash when demand is there. This quarter, Union Pacific captured that demand efficiently. The only real softness in bulk was food and refrigerated, where revenue fell 5% and carloads fell 9%. That looks more like a quarter-specific issue than a structural problem. Now let's move to industrial. Industrial revenue came in at $2.191 billion, up 5% year over year. Industrial chemicals and plastics rose to $655 million, up 8%. Metals and minerals reached $555 million, up 7%. Energy and specialized markets came in at $663 million, up 5%. That is a solid read on the underlying economy. Chemicals up 8, metals up 7. Those are not recession type numbers. They suggest demand for the materials that build things and make things is still holding up. Now for the soft spot, premium. This is where the quarter was not perfect, and it is important to say that clearly. Intermodal came in at $1.116 billion, down 6%, with carloads down 9%. Automotive was $560 million, down 4%, with carloads down 6%. Overall, premium revenue was $1.676 billion, down 5%. Intermodal remains under pressure because trucking capacity is still loose and trucking rates are still cheap. When truck prices stay low, some freight shifts away from rail intermodal. Management has been consistent about that. They believe it improves when the truck market normalizes. That normalization still has not happened. Automotive was weaker too, and tariff uncertainty appears to be part of that story. When production schedules and import flows get less predictable, rail volume feels it. So yes, premium was the weak spot, but here is the key context. Bulk and industrial more than offset that weakness. And even with total carloads down 1%, average revenue per car was up 4% across the network. That matters. It means Union Pacific hauled slightly less volume, but earned more per unit and did it with better efficiency. That is pricing power. That is network quality. That is the moat, showing up in the numbers. Service drives price. Price supports the thesis. And in Q1 2026, both held. This is the section of the report I go to first, because revenue can be influenced by mix, pricing, and timing. But operating ratio and productivity metrics are harder to fake. They tell you whether the machine is actually getting better. And this quarter, the message is clear. Union Pacific is running better than it has in a long time. Let's start with the operating ratio. Reported OR came in at 60.5%. Adjusted OR was 59.9%. The street was looking for 60.5% adjusted. Union Pacific delivered 59.9%. That is 60 basis points better than expected and 80 basis points better than Q1 of last year. And that matters because Q1 is usually a seasonally softer quarter. So when you see a sub 60 adjusted OR in the first quarter and a clear improvement from 60.7% a year ago, that tells you the trend is real. Now let's go to productivity, because this is where the quarter gets even more impressive. Freight car velocity improved to 235 daily miles per car, up 9%. Best first quarter ever. Terminal dwell dropped to 19.7 hours, an 11% improvement. Best quarter in company history. Locomotive productivity improved to 144 gross ton miles per horsepower day, up 6%. Best quarter ever. Fuel consumption rate improved 4% to 1.064 gallons per thousand GTMs. Best first quarter ever. Workforce productivity rose to 1,163 car miles per employee, up 7%. Best first quarter ever. And average headcount fell to 28,647 employees, down from 30,146 a year ago. Stop there for a second. Union Pacific moved freight faster, reduced terminal time, got more output from its locomotives, burned fuel more efficiently, and improved labor productivity, all with roughly 1,500 fewer employees than a year ago. That is not a company drifting. That is a company executing. Now, let's walk the income statement. Total revenue rose from $6.027 billion to $6.217 billion, up $190 million or 3%. Compensation and benefits increased just 1%, from $1.212 billion to $1.227 billion. Fuel expense rose 7%, from $603 million to $643 million, reflecting higher fuel prices, partially offset by better fuel efficiency. Equipment and other rents fell 9%, from $241 million to $219 million. Operating income increased to $2.458 billion, up 4%, and net income rose to $1.701 billion, up 5%. That cost structure tells a story. Compensation was tightly managed, equipment rents came down, productivity improved across the network, and those gains flowed directly into margins and operating income. That is operating leverage. That is network discipline. And that is exactly what you want to see from a railroad trying to widen the gap between itself and the rest of the field. I want to spend a minute on a metric that rarely gets enough attention in standard earnings recaps. And in my view, it explains Union Pacific's premium valuation better than almost any other single number. Return on invested capital, ROIC. In plain English, ROIC asks a simple question. For every dollar invested in this business, whether from retained earnings, debt, or the billions spent building and maintaining the network. How much after-tax profit does that capital produce? That matters because revenue can be bought, growth can be borrowed, margins can move around quarter to quarter, but sustained, high returns on invested capital are much harder to fake. If a company consistently earns returns above its cost of capital, it is creating real value. And if it can do that year after year, it usually means the competitive advantage is real. Now look at Union Pacific's trend. In 2021, ROIC was 14.2%. In 2022, it rose to 16.8%. In 2023, it normalized to 15.3%. In 2024, it recovered to 15.8%. In 2025, it reached 16.3%. And on a trailing 12-month basis through Q1 2026, it is approaching roughly 16.4%. Step back and look at that arc. From 14.2% in 2021 to roughly 16.4% today. That is not an accident. That is years of operational discipline showing up in the most honest measure of business quality there is. Union Pacific is generating more profit from every dollar of capital tied up in the railroad. That is what quality looks like. Now put that in peer context. Union Pacific sits around 16.5%. BNSF is around 13.5% on an estimated basis. CSX is around 11%. Norfolk Southern is around 10.5%. Canadian National is around 10.4%. That gap matters. Union Pacific is not just modestly ahead, it is operating at a materially higher return on capital than the rest of the peer group. And when that kind of gap persists over years, it stops looking cyclical and starts looking structural. That is why the stock earns a premium multiple. When investors ask why Union Pacific trades at a higher earnings multiple than rail peers, this is a big part of the answer. You pay more for a business that earns more on its capital. High ROIC, sustained over time, is not just a story about a moat, it is the evidence of one. Let's follow the cash, because that is where the real story usually lives. Not the adjusted EPS, not the press release language, the actual movement of actual dollars. Start with the cash flow summary. Operating cash flow came in at $2.44 billion, up $230 million, or about 10% versus Q1 last year. That is the engine behind everything else. Capital investments were $937 million, which keeps the company on pace for its full-year capital plan. Dividends paid were $821 million, or $1.38 per share, up from a year ago. And free cash flow came in at $631 million, up $163 million, or about 35% from Q1 2025. That is a meaningful jump in free cash flow in a single quarter, and it happened while Union Pacific still spent heavily on the network and still raised the dividend. That tells you the improvement is being driven by stronger operating cash flow, not financial engineering. Now go to the balance sheet, because this is where the quarter gets even more interesting. The cash balance moved from $1.266 billion to $735 million. That is a decline of about $531 million, and a big reason is simple. They used cash to pay down debt. In the quarter, Union Pacific repaid $1.172 billion of debt. At the same time, adjusted debt to EBITDA improved from 2.7 times to 2.5 times, and shareholders' equity increased from $18.467 billion to $19.418 billion. So this was not a quarter where cash simply piled up on the balance sheet. This was a quarter where cash got put to work. And that brings us to capital allocation. The priority stack is pretty clear. First, debt paydown. Second, the dividend. Third, capital investment in the network. And fourth, buybacks, which are currently paused while the merger process is pending. Now let's move to guidance, because this matters just as much as the quarter itself. Management fully affirmed full year 2026 guidance. Not partially, not with caveats. Fully affirmed. EPS growth mid-single digit for 2026, consistent with a 3-year CAGR of high single to low double digits through 2027. Operating ratio expected to improve versus the 59.3% adjusted level in 2025. After a 59.9% adjusted OR in Q1, they remain on track. ROIC management continues to point to an industry-leading level, with the business still tracking above 16%. CapEx, $3.3 billion for the year, with Q1 spending of $937 million, keeping them on pace. Pricing, still expected to exceed inflation, and Q1 supported that with revenue per car up 4%. Dividends. Continued annual increases remain part of the plan, and Q1 delivered $1.38 per share. Why does holding guidance matter so much? because after Q4 2025, there were real questions about whether management would need to walk back its 2026 targets. They did not. Instead, they came into Q1, reaffirmed the full year outlook, and backed it up with results that beat expectations in the key areas that matter most. That is how credibility gets rebuilt with the market, not with promises, with performance. Now we need to turn to the biggest variable in the Union Pacific story right now, the merger. The next hard checkpoint is April 30th, 2026. That is the deadline for Union Pacific and Norfolk Southern to submit their revised merger application to the Surface Transportation Board. Here is the timeline. July 29th, 2025, the merger agreement is signed, an $85 billion deal with Norfolk Southern shareholders set to receive $320 per share. November 14th, 2025, shareholders at both companies approved the transaction by an overwhelming margin. December 19th, 2025, the initial merger application is filed with the STB. January 16th, 2026, the STB unanimously rejects the filing as incomplete, citing three main deficiencies: missing post-merger market share projections, incomplete merger documentation, and inadequate treatment of the Terminal Railroad Association of St. Louis. February 17th, 2026, Union Pacific confirms it intends to refile and targets April 30th. April 23rd, 2026. Today's earnings release includes $36 million of merger-related costs and confirms management is still moving forward. April 30th, 2026. The revised filing is due. So what matters in that filing? You want to see whether the company has actually addressed the STB's objections in a serious way. That means real market share projections, complete merger documentation, and a clear treatment of the Terminal Railroad Association issue. Because if the revised filing only smooths over those deficiencies instead of solving them, the process likely gets pushed out again. My assessment of the probabilities looks like this: about a 20% chance of approval as proposed, about a 30% chance of approval with meaningful conditions, about a 25% chance of prolonged delay, and about a 25% chance of rejection or deal withdrawal. In other words, roughly a 50% path to eventual closure, but with significant uncertainty around timing and terms. So yes, the quarter was strong, but watch the April 30th filing with the same discipline you brought to this earnings report, because right now, that filing matters almost as much as the quarter itself. Here's the thesis checklist. Business quality, exceptional. Best operating ratio in North American rail. Best ROIC in the peer group by a wide margin. Multiple operational records in a single quarter. Earnings growth, on track. Adjusted EPS was up strongly, and full-year guidance was fully affirmed. Free cash flow, real, durable, and improving. $631 million in Q1, up 35% from a year ago. Dividend, safe and growing. $1.38 per share this quarter, with solid cash flow support. Balance sheet, still levered, but clearly improving. Adjusted debt to EBITDA moved from 2.7 times to 2.5 times in a single quarter, and debt paydown is tracking ahead of the pace needed to meet management's first half target. ROIC around 16.4% trailing, still the highest in the peer group by a meaningful margin. This remains the quality anchor. Merger risk, real, unresolved, and still the dominant near-term variable. April 30th is the next major checkpoint. Valuation, reasonable but not cheap. At roughly $262, Union Pacific trades near its historical forward earnings multiple. The free cash flow to enterprise value yield still suggests investors are paying up for quality. Now, the soft spots. Intermodal was down 9% in carloads. That is real weakness. The truck market still has not normalized, and that stays on the watch list. Automotive was down 6% in carloads. Tariff uncertainty is creating real pressure on vehicle production and shipping patterns. Neither of those breaks the thesis, but disciplined investors do not ignore weak spots. They note them, track them, and see whether they improve or spread. So here is the final log entry for April 23rd. 2026. Union Pacific delivered a strong quarter. They beat on operating ratio. They beat on earnings. They beat on revenue. They beat on freight revenue growth. They set multiple first quarter records. They fully affirmed guidance. They reduced debt materially. And they grew free cash flow by 35%. The machine is running at altitude. The gauges are mostly green. The one instrument still flickering is the merger. When that revised STB filing drops on April 30th, read it carefully. Not just the headlines. Read the substance. Look at the market share projections. Look Look at the treatment of the Terminal Railroad Association. That is where the real signal will be. For me, the Union Pacific thesis remains intact, and after this quarter, it is improving. Thesis status, improving. Hold with conviction. I'm Captain Pierce with SkiesCapital. Think clearly, invest better. If this analysis helped you think more clearly about Union Pacific and the long-term thesis, subscribe and ring the bell. I cover earnings reviews, deep dives, and portfolio analysis for long-term investors who want to understand what they own, not just what it trades for. Drop your questions or your take on the quarter in the comments below. I read everyone. I'll see you in the next entry. Captain's Log, out.